Now, many of you already know by now that the South African president, President Ramaphosa, our president, during the State of the Nation address on Thursday, he indicated that they're expecting, or the target is to get the South Africa's economy to grow at 3%. So the GDP forecast, they're expecting the GDP to be at 3%. You will know that in Q3, GDP for South Africa contracted by 0.3%, which was something that was not good. And to see that, obviously, the president on Thursday, he is saying they are targeting a GDP of 3%. I think it's a good recovery. It's a good thing. Though, for countries like South Africa, what attracts investors to come maybe is a GDP forecast of 5% and above. But 3%, I don't think it's that bad. I mean, 3% on well-developed countries or in well-developed countries, it's a very good economic growth annually. 3% is a very good growth. But to countries like South Africa, countries like China, India, which are emerging markets, 5% is what investors, or what really excite the investors, which therefore this 3%, it is lower, or it does not excite the investors that much, which is why you even heard some other people after the State of the Nation saying that obviously South Africa should strive to get to 5%. I mean, there are quite a number of things that South Africa can do to obviously get to 5% GDP growth. Number one, create jobs. Number two, advance your current technology, which during the State of the Nation, you'll notice that the President of South Africa was mentioning a lot of AI, artificial intelligence, which, of course, this is what investors want, because in countries like South Africa, investors, big institutions want to see a pretty good solid growth, which, like I said, 5% should be the base for South Africa and not 3%. But 3%, it's still not that bad. But let's see how these things will unfold. I mean, one thing that I can tell you, investors are really shifting towards the emerging markets, meaning that investors are really focused on to investing into countries like South Africa, countries like China, India, because these are emerging markets, Brazil. These are countries where there is growth that is expected to take place. South Africa, we are rich in gold. We've got lots and lots of minerals. And because of this, our economy can continuously grow, can continue doing very well. These emerging markets offers good opportunities for these investors to profit for the long term, which is something that obviously it's a great thing. 3% is not that good for South Africa. They should target 5%. But again, looking based off what we are coming from, I think it's getting better. I mean, one of the things that really hurt our economy so bad was things like load shedding, things like high interest rates, which obviously was making consumers to not go out there and spend as much because the loans were too much, and therefore consumers could not buy some of the products they used to buy, some of the services that they used to have, and therefore this harms the economy. It is for this reason that you will see countries like China right now announcing stimulus, $1.4 trillion stimulus to support the economy, because inflation in China is also very low, and this is not good for a country. Though their GDP is 5%, or in fact 5.4%, it is something that is good for them. China is in a very good position, because what they need to do right now is just to continue giving their consumers subsidies to make sure that they stimulate their spending, drop down interest rates or cut on interest rates, which that will make consumers to go and spend. But us, this side, remember, we don't have stimulus. But anyways, I think the more we continue creating jobs, our economy should be fully functional, continue advancing our technology, our economy will continue growing, which is something that as a result will positively bring some impact, or a good impact, into our economy. So yeah, man, this is what I thought I come and give you to say that 3% that President Ramaphosa said, based off what is expected by investors, it still falls short, because emerging markets, at least they should be getting or having a GDP or annual GDP of at least 5%. This is what will attract investors to come and invest into that country, which is why China right now, you will notice that investors are really focusing, or their eyes are in China, simply because of the advancement that they are seeing into China, simply because of the new technology that they are seeing into China, And over and above that, because their GDP growth is at 5.4%, or for Q4 it came at 5.4%, which shows you the kind of growth that we are seeing onto China. This is massive, this is bullish, and it is for this reason that you see big investors going into China wanting for investing opportunities, which is why now, based on my personal opinion, not professional financial advice, you need to also look at some assets that you can buy in China in terms of stocks, right? Because when you look into the New York Stock Exchange, there are so many Chinese stocks that are listed there. So it might be the good time right now to have a look and reconsider the stocks or the Chinese stocks. See if you can grab one or two, or ETFs. But again, these are just my opinions, not professional financial advice. So that's all from me, man. South Africa just needs to make sure that they continue growing the economy, and the economy goes back to 5%, because that's what will attract quite a number of investors to come and invest into our country. Otherwise, until we get there, we are not going to see that much of investments. But again, 3%, it might obviously start make people to come, because I mean, let's face it, in as much as we are an emerging market, we cannot be compared to China. China is way far ahead as compared to us. So that their 5%, our 3% might be good enough to attract investors to come and invest into our country, which that will be good, that will be great, and we need to have that at the back of our minds. Otherwise, that's all from me. I wish you nothing but the best, and God bless you all.